Hi, this is a trade alert for Google. We're going to show you the bull call spread strategy. We're going to actually place a trade, and then later on we're going to show you different ways you could actually vary the trade if you wanted. Okay, so the first thing, a bull call spread, it's a mildly bullish trade. The reason we say mildly is that if you were more bullish, you would probably just buy long calls or buy the stock itself. It's a debit spread. It's going to cost you to place this particular trade. How do you construct a trade? Well, the very first part of the trade is you buy a call option at a strike price, which is out of the money or in the money. We'll explain which ones you would pick later on in the presentation. But in essence, what you're doing is you're buying control of the shares at a certain price by an agreed date in the future. And then the second part of the trade is you're selling a call option, or you're selling control now at an agreed price, which is higher than the ones that you bought, for the same expiry in the future. It's usually placed as a combination trade. We'll show you how you would do it for real later on. So let's go look now at some of option quotes there for Google options. So I'm just going to show you here how we go about getting the prices for our options. So we're in the Option Trader Interactive Brokers, and we're now just going to select the expiry that we want. So we have a $700 price target, but let's say up to Christmas we might think it's going to get to $650 or whatever. So that's our target price to Christmas. So we've selected the December expiry for the options, and now we're going to edit the amount of strike prices that we want to look at. So we're going to look at strike prices right up to $650 and maybe $5 increments. So that's what we're looking at the moment. So once we get all of them, then we can start using these prices here to start plugging into our spreadsheets. So for now, we'll focus on the 635 and the 650 bull call combination. We're going to take the pricing from here that you can see in front of you, and then we're going to put it into our spreadsheets. So now we're going to show you how to place this trade. We're in the order management window, and you can see here there's a lot of tabs along the bottom. We're going to click on spread on the far right hand side. So we click on spread, and you can see the strategy it opens up is vertical. There's a lot of different strategies in there, but we're placing a vertical trade. So it's Google. We're going to type in here, and you can see two orders are automatically going to populate up here. So we're going to use the 635, 650. This is a real trade we're going to place, and we're going out to December. And you can see here the first trade is to buy the Google December 15th $635 call option. Now this trade is actually being placed in the pre-market at the moment. So these quotes are a little bit off, but we know from last night's support meeting generally what we're looking to place in this particular trade. We know we're going to place a debit of 710. Now the second part of the trade, they've populated to 640. We're going to change that to 650. And you can see here that they're giving us a bid of around 720. We're going to look for 710. I need to pay 710 for this particular trade. Okay, so we come down here. It's a debit spread. The quantity is 1. They're saying the limit price is 720. We'll change that to 710. We'll leave it in there for this as a day order. We're not going to chase this particular order, and we'll click on preview. So it's saying here, you're sure you want to buy one December $635 call. Second leg is, do you want to sell one 650 call? And the answer is yes. We'll submit the order. You'll get a number of these warning windows. You can just cancel them off out, and there it is sitting in the system there. Now we've put in a limit here in the pre-market is 710. If we don't get filled on this, we might up that to 730 later on, but we just wanted to show you how to place the trade for now. So let's go through this bull call spread on Google. Google was trading at 633. We placed the 635, 650 December 18 bull call spread. So the first part of the trade is we bought the 635 call and we paid roughly 33.70. And then the second part is to sell the 650 call and receive 26.60. So just to remind you, trade number 1, we're buying control of Google at 635. Trade number 2, we're selling control of Google at 650. That's the net cost is $710 or $710 per contract. The reason it's $710, one option contract controls 100 shares of stock. So what's our risk? We won't lose any more than $7.10 per share in this particular trade. So the maximum amount of risk in this is $710 per contract. What's our maximum profit? Well, the maximum profit in this trade is equal to the difference between the strikes, which is $15, minus the debit we paid, which was $710. So our max profit is $790. In essence, we're risking $710 to make $790. Our break even is equal to the lower strike price, in this case which was 635, plus the debit page which was 710. So our break even is for Google to trade above $642.10. Now what's our probability of success? Well, it's lower than normal because our break even is now above where our current share price is trading. So what you could actually do is increase the probability of success by choosing different strike prices. So we want to give you different options. We're going to go through an Excel spreadsheet now and show you that so you can amend the strike prices if you wish. So what you're looking at here is profit and loss tables for our Google bull call spread. So I've actually done 3 versions. So I'm just going to talk you through the very first one. We're going to upload this spreadsheet to the members area of the website. But we're going to show you the difference here about picking the different strikes. So this is an out of the money bull call spread with wide strikes. So this is the trade we just talked about. It's buying the $635 call and the cost of it, and then the second part of the trade was selling the 650 strike and the cost of it. Current share price of Google at the time is about 633. So in profit and loss tables, anytime you're doing option trading, you need to get used to doing these profit and loss tables. And what we're doing is doing a what if scenario. All we're saying is, well, what if Google was at $600 on the 18th of December? What does that mean in terms of profit and loss for me? What if it was at 610? What it was at 620, etc. So we normally pick a range, you know, of about 10 or 20 different values, but you can do as many or as little as you want. So the first line is you put in the information you know. Well, you know that the cost of your long calls was $33.70. So we put in minus $33.70 there because it's a cost. That's what we paid out to buy the right to buy Google shares at $635. Then the second part of the trade was we agreed to sell shares of Google at $650. So that's basically selling the calls. And that income from that, for us agreeing to do that, we received in $26.60 per share. So those two values are known. So now we've got to imagine we're at the 18th of December, the share price of Google is at $600. So what is the value of the $635 calls? And the answer is 0. There's no in the money or real value left in those call options. And if you think about it logically, if the share price of Google is trading at 600 on the 18th of December and somebody has the right to buy the shares of 635, why in their right mind would they do it? Buy it at 635 when they can go into the market and buy it at 600. So there's no value left in these call options. And that's true for every case right up to 640 here. Now at 640 there's $5 of real value in this $635 calls. And the reason is, if you think about it again, you can go and buy Google shares at 635, sell them back to the market immediately at 640, so there has to be $5 of value left in that call option. At 650 it's 15, at 660 it's 25, and so on and so forth, all the way up to 700. Then we get into valuing the $650 calls. And again, there's no value in those call options right up to 650. But you're going to see a minus 10 here at 660. So why is it minus 10 for us? Well, think about it like this. We've now given somebody else the right with these short calls to take the shares from us at 650. They can now sell them in the open market at 660. So if you think about it, there's a value of 10 in that option. We don't own the option, we sold it. So it's minus 10 for us. In other words, it would cost us $10 to buy back that call option contract. At 670 it's minus 20, at 680 it's minus 30, and so on and so forth. So when we get to the profit and loss on a per share basis, all we're doing is adding up these 4 columns all the way across, and you can see that no matter what happens with Google, all we can lose is $7.10 per share. At 650 we're making $7.90 per share, but you can see that our profit potential is capped as well right up to 700. So our investment in this scenario is 710. Our break even is above 642.10. Our max profit is 790, and our return on investment potential is 111%. So that's very, very attractive. Now the great thing about this particular trade, let's imagine Google did drop to 600. If you would have bought the shares of Google today, you would have lost $33 per share. Whereas by placing this strategy, all you can lose is 710. So 710 might be still a bit of a risk for people. So you can actually reduce the cost of this trade by narrowing the strike prices. So our second example is this one here. This is where we actually bought the 645 strike at 28.70, but this time we sold a 650 as well. So the difference between the strikes is only $5. So you can see here when we go through our profit and loss tables, our maximum risk is now reduced to 280, but our max profit is also reduced to 220. So the difference between the strategy up here and the strategy down here is we've just narrowed the strike prices. Cost of the trade is less, but our max profit potential is less as well. And our return on investment is 79%. Now this is still out of the money. And on our third one, if you would have picked in the money strikes, so that's strike prices below where the current share price is trading. In this case, we picked 625 and 630. You can see that our investment has gone up a bit, which is 360. And our max profit has dropped substantially to 140. And our return on investment is 39%. Now, the reason your max profit has dropped, your chances of winning on this trade have actually gone up way over 50%. So up here with this one, because we picked out of the money strikes, our probabilities were about 30%. On this one, our probabilities are over 60%. And the reason is our break even is now at 628.60. The shares are already trading above that. So we've given ourselves a better chance of winning with this trade. Okay, our costs are 360. We're only going to make a 40% profit, but hey, I still think it's pretty interesting. So what you've got to learn from this is you take more risk by picking wider strikes. By narrowing the strikes, you reduce your risk because your cost is reduced. But going in the money, you're going to make less money. Your costs are going to be slightly higher, but you have a much better chance of winning. So it's up to you as an investor to pick your target price first. And once you've picked your target price, you then can manipulate your risk by the different type of strategies and strike prices you pick. So we're just going to close off the presentation now and move on. To finalize, just in terms of picking the strikes, if you're most bullish, you pick strike prices which are out of the money. In Google, we pick both strike prices out of the money, so we're really bullish on Google. If you're only moderately bullish, you'd pick a strike price where the share price is in the middle of the two. So in the example of Google, you might pick 625, 640, for example. And when you're least bullish, you could do both calls which are in the money. And the example we gave was 625, 630 there. That's where they're in the money. And really what we're doing there is taking advantage of time decay. So for our Google trade, we are most bullish. Managing the trade. So let's say we get to the 18th of December. First thing is to note you can close back the trade at any stage by buying back the short call and selling the long call. So you can close the trade down very simply or do it as a combination. Usually these trades are kind of left to expiry. If the share price is below the short strike price at expiry, do nothing. If the share price is above the short strike at expiry, you got to close the short call option and sell the long call option. And again, if there's any premium at expiry in the long call option, you obviously sell that as well. Okay guys, if you'd like some mentoring on options trading, please contact us, let us know, give us a phone call, and we'd be delighted to help. We hope you enjoyed the presentation. Thanks and bye.